Hello and welcome back. Happy Monday, happy Easter, happy Passover. I hope everybody had a great holiday, whatever you celebrate. I hope it was wonderful and time well spent with your families. Welcome back. I took last week off, but I am here now. I am Jackie Baker, and you are here for your live dose of real estate reality. So I'm a real estate agent here in northern New Jersey. I come here weekly on Monday nights, and we talk about what's going on in this wonderful real estate market. So mortgage rates are going back down again. Yeah. So all this frenzy about the Feds raising interest rates, everyone was freaking out. Here we go again. And oh my God, look at that. The mortgage rates are going back down. What in the heck is happening? What's going on in this crazy market? So this week I have with me Mr. Manny Rizzuto from NJ Lenders. So I'm going to bring Manny on. Hello, Manny. How are you?
I am great, Jackie. Thank you so much for bringing me on.
Okay. No, I'm so glad you said yes. So just to tell the audience, Manny and I had done a transaction together back in December. He was the lender for my buyers and did a fantastic job. We had great conversation. The deal just went so smoothly, like on the loan end. The other end, we're dealing with the sellers, not so much, but we got through it. That was one of my more challenging deals as far as working with the seller and the listing agent. It was not fun, but it was a pleasure working with you. You made life very easy for me. So thank you. And for our clients, they were really appreciative. So
and I feel the same back at you. It was great working with you, which is
thank you.
Why I think we remained in touch, right?
Absolutely. Absolutely. So, all right. So Manny, this is crazy. Like, here we are. It's April 10th. We're going into the middle of May. Now, this is when the spring market is really heating up, right? And I'm still seeing the lack of inventory, yet the mortgage rates are coming back down. Now, I want to bring up the article that I wanted to touch on tonight. Let me just, let me pull you up. Here we go. So this is from Realtor.com. Mortgage rates just dropped again. Is it enough to save the spring housing market? So this goes on to say, for the week ending April 6th, the interest rate for a 30-year fixed rate home loan averaged 6.28%, according to Freddie Mac. Although that's much higher than a year ago when rates were at 4.72, it's still at least down a bit from the 20-year high they reached near the end of last year. Compared to the recent 7% average rate peak, the latest rate saves $140 per month for a home buyer on a $300,000 loan. This is coming from Larry Yoon, who's the chief economist from National Association of Realtors. And it says here, they say he's optimistic that the rates will continue this downward trend. I have to tell you, I love Larry Yoon. He's great. He's always optimistic. And in this doom and gloom world we're in, he's always the one, like the shining light, like, I think we're going to be okay. So Manny, tell me what's going on. What are you seeing in your world with the rates and the loan applications, all the things?
So I'm seeing loan applications rise. I'm seeing people very interested in talking about how they could make either a sale and a purchase, or their first time home purchase. I am seeing a lot of activity in the buyers that want to discuss, right? But I think the vast majority of the media, the way that you alluded to, this one gentleman in an article who is positive, and I like what his mindset is. I believe his mindset to be true, which is rates are going to continue downward for a variety of reasons that we can get into. But I think that our job right now is to make sure that we control the narrative in our local market. Don't let the national media scare, people away from at least talking about it, because ultimately when we have these conversations, when I have the conversations with clients, they see how they can make, the numbers work. And also I give them a little bit of a plan to see it down the line. So I'm seeing it very positively, but I think it's not so positive in some of the media that's out there.
Exactly. But the frustrating thing is the very lack of very little amounts of inventory. That's very difficult. And I know here in the Northeast, like New Jersey, prices are still kind of high. They haven't come down a whole lot from what, like in my experience. But you have other markets around the country, such as California, like LA, Phoenix has been affected. Seattle's been affected. They're seeing big drops in prices out there. They're just truly overinflated. So that's good for buyers out there. But is it going to bring on more inventory? No, because now sellers are going to be freaking out. They're not going to get the money that they could have gotten a year ago. So we just discussed this before we came on, and everybody knows I talk about this every week. Like, it's about the golden handcuffs, right? I mean, majority of people have interest rates below 4%, and if we continue this downward trend, right, we're at 6.28 today, and say in a couple of months, so say after May 10th, which we'll talk about that in a little bit, why we need to keep our eye on May 10th, but if they come down into the 5% range, is that going to be enough to make sellers want to sell their house and move and trade up or trade down? So, Manny, you had something really interesting. Can you pull that up again? That screen you have with the showing the numbers, like, so
Yes.
if somebody, so let me just go on and say, like, so say you have interest rate 3.75%, and now the rate is down to 5.25%. What is that difference? What does that mean? So Manny's going to show us. And it's very interesting because I found this to be really cool, because Manny pointed something out that nobody's thinking about, because the media is in our heads telling us, rates are high and the market's crashing, but a lot of salaries are going up. People are getting better paying jobs, or they're getting raises at their jobs. So that can help contribute to make it affordable. Not only are you going to earn equity, you're getting a lot more equity in your house, so you're making more money. You have more money to put down on the next place, but your salaries increase over time. So, all right, do you have that, Manny? Let me pull that up. Okay, here we go. Okay, so here's the chart. So, Manny,
Yes.
do your thing.
So you guys can see the screen, right? My screen. Okay.
Yep.
And so what this is depicting is exactly what Jackie was saying. We've got, let's say last year, a loan amount was $400,000 that you borrowed. Same for 10% increase, let's say in housing, up to borrowing roughly a $440,000 loan. You're seeing, the interest rate going up from 3.5 to 6.25. You're seeing the payment go up roughly $913. It's depicted right there.
Yep.
So what I think, like you said, the media is focusing on and falling in love with is that, oh my goodness, look at that payment increase. I can't go anywhere. But I think what we also don't focus on is this increase, which ADP has reported. Year over year, we're looking at a $9,000 on average. If you take a $100,000 annual household, right?
Yep.
They're making a 9% increase on average between people who stay at a job, 7.6% increase in income versus someone who's switching their job, which was over 15% increase. So that's an average of 9%. So if you're making $100,000 a year, that's $9,000, which is depicted there.
Yep.
You're almost breaking even if you are taking into consideration your increase in income. And I think, not that we want to spend more money when we make more money. I understand that, but we have to take into consideration the fact that our earning potential, like you and I were talking about also before, yep. When our dads, because my dad said the same thing, he said, look, you're not even at the peak of your earning potential when I bought my first house.
Exactly.
And I don't think, it's something that people take into consideration, is that earning potential and where they're going to go with their income. And like you said, did you ever take a job that was paying you less? And the answer is probably no.
Nope.
For everybody that's listening.
Mhm.
I think we're all working to make more money, and that's what we're doing, and that's what's happening, right? So if we take all
Exactly.
that into consideration, and then we go roll this thing a little bit forward, which is the lower portion here, where okay, you're still locked in at your 440 loan amount or price, however you want to look at it, right? Because you closed and bought the house, and you
Right.
got 6.25. Well, my job as a mortgage planner is to stay in touch and make sure that we have the most affordable mortgage for the life of the loan. And
Yep.
so I believe that in the next several months, whether it's 1 month, two, three, four, or 12 months, whatever the case is, but it's going to be over the next short term, where we will have an opportunity to lock in lower rates and
Mhm.
decrease your mortgage payment. And that's depicted there by an example of a 5% rate.
Yep.
That's depicted by that $2,300 payment. And I think that's kind of the mindset that we need to have in trying to take advantage of building wealth through homeownership.
Exactly. So now let me ask you. So it's true. So if you're going to go refinance, right? They say to refinance only if you're a point lower, or do you have a point like right here, you go down from 6.25 to 5%, right?
Yeah, it's a great rule of thumb. 1%, that's a great rule of thumb. There's
Okay.
obviously, different circumstances that make for different thoughts and different process, but a rule of thumb sure is a 1% decrease. Yes.
Okay. Now, closing costs again. Now, it's got to make financial sense too, right? I mean, you're going to be paying
You
closing costs all over again.
you took the words right out of my mouth. That is during the refi boom of 2020, 2021.
Yep.
That was every word that was spoken out of my mouth to every client that I spoke to. This has to make it doesn't it's not might make it Mr. and
Has to make
Mrs.
sense.
Customer, this
Yep.
has to make financial sense for you. Let's go through the numbers and we figure out what's what. I'm very transparent in how I deliver those numbers before, the word go. On a refi, there's no pressure. You don't have to do anything. You're in the house.
Yep.
So we're going to make sure, and my job is to make sure that it makes financial sense. So thank you for saying those words, financial sense, because that is everything about a refi.
Exactly.
Yeah.
Exactly. Okay. All right. That's awesome. So what products are you finding people are using more nowadays? Is it still 10-1 or a 5-1 arm? Like
You know, it,
what's the product of the day in the mortgage world?
yeah, I would say that there's some 7-1 arms, there's some 10-1 arms, um, some 5-1 arms. But honestly, the vast majority of my families that I help are looking at still the 30-year fixed because I think that's their comfort, the vast majority.
Exactly.
My
Yeah.
personal belief, my personal comfort, my DNA, the way I was raised is on 30-year fixed. That's just how I am.
Yeah.
But I have to say that most of the financial advisors that refer me, most of the CPAs that refer me and talk about their own transactions with me, they
Yep.
all look at these short-term arms. They look at even sometime interest only. And I think that's because they understand a lot more of the principles that are at play. They also might have larger earning potential where they can prepay the loan and control their narrative a little bit more freely. So it depends on the client, but I would still say vast majority we're talking about 30-year fixed.
Yeah, that makes sense. Yeah, because I still think, even though these arms can be a great product, people are still scared. You don't because of what's been going on. It's so unpredictable. They don't
Yeah,
wanna risk that rate. Them paying more money
yeah.
at the end of that term. I mean, and I did videos about this too. It's like you got to look at every worst case scenario when you're looking at those arm loans. Like, what is the absolute highest amount that your mortgage payment can turn into should you not refinance? And then at the end of that term, you have your rate's going to jump up to whatever. Like, you got to be prepared for that. Got to understand that number. Don't just walk into it blindly. But I think people just, you're right. They just get comfortable with the 30-year fixed. So, but
And look, at the end of the day, I'm not afraid of any arms. I'm not afraid of them blowing up the way that they would have prior to 2008. I've been a
Mhm.
mortgage professional since '01. So I've seen what happened. I've seen how it happened. It's not
Right.
nearly like what it was in '08, but I think I would be doing my clients a disservice not to talk to them about the adjustable rate mortgage. But then ultimately, it seems that when the dust settles and we give them kind of, here they are side by side, I think the comfort level goes to, a 30-year fixed, unless there's some affordability issue, and then we could talk about it. But we are on the same page there, I think.
Yep. Yep. Okay. All right. Let me just jump back to this really quick.
You want me to stop sharing?
Oh yeah, that would help. Hold on.
Okay,
Let me take that off. There we go. Okay. Thank you.
you got it.
All right. So let's go on to the rest of this article. I want to bring this up. It says, get rid of that. Mixed bag for home buyers this spring. So it said this spring season presents a mixed bag of trends for both buyers and sellers. This is coming from the Realtor.com economic data manager, Sabrina Spinu. I think that's how you say her name. For one, listing prices for the week ending April 1st are still higher than last year, although barely so, growing by just 4.4%. Home listing prices are advancing at the slowest pace since June 2020 and could slow further. Oh my God. Realtor.com economists have previously forecasted an outright price decline by the summer, and the national median sales price, what the buyers and sellers agreed on, has already begun to fall for the first time in over a decade. Still, with listings hovering at a median asking price of $428,000, the final week of March and beginning of April still registered higher prices than all but what the priciest 5 months of 2022. And this I love, the incredible shrinking housing market. This is like the perfect term for this. Another downside for buyers is that the week ending April 1 marked the 39th straight where fewer homeowners listed their homes for sale. Lower levels of fresh new home listings continue to constrain home sales, which continue to remain at low historical levels. With the total number of real estate listings is up 53% compared with a year earlier, many of those housing options are stale, picked and passed over already. On average, listings lingered 18 days longer than this time last year, a continuing sign that buyers aren't impressed by their options. In fact, properties have been idling longer for 35 weeks in a row. So this is another big issue. So with this inventory and it not increasing, which is why I brought up this whole thing, like what's going to motivate sellers. But here's the thing, those people who are putting their house out on the market now, some of them they're overpricing. I'm seeing it. I'm seeing homes sit. And you're right. The ones that are left are the ones that have been picked over. Nobody wants it. And sellers are still stuck on the fact that they think they can get the price they could have gotten 2020 or 21 or last year. So this is another big thing, and it comes down to affordability. So even though it says in this article, yeah, rates are coming back down, we still have this issue where sellers need to start getting more real about their price, and they have to listen to the real estate agent. It's just, I know they look at us like, we're out to make a quick buck. We just want to sell their house. But where the reality is, it's like, no, we're telling you where the market is, and you need to be in line with the market. Now, the clients that you've been working with, Manny, are they in bidding wars? Are you seeing that a lot?
Oh yeah, absolutely. And it's ultra competitive, and I don't think it's going to get any easier.
Mm-hmm.
I think, with the demographics of the millennial generation and, all the ages around the millennial generation, I think that demand is going to remain strong just based on sheer numbers. And
Yep.
then you were talking about supply being at, an ultra low, the incredible shrinking housing market,
Yeah.
So, yeah, I mean, people are going, 10% over asking price in many cases.
Yeah.
And coming up short. I had somebody offer, and a good offer, and with a significant amount down, and they were $100,000 off on the highest offer. They found out afterwards it was a $1.2 million offer that came in, and they were at 1.1.
Oh
and
my God.
they were
Yeah.
super well qualified. I reached out to the listing agent, to,
Yeah.
give my vote of confidence.
Yep.
And so to answer your question, it's competitive. It's
It
super
comes,
competitive.
but at the end of the day, it just comes down to price. And what it worries me to hear that like 100,000. Oh my God. So we have this, I don't think she's with us this week. She's usually there's an agent, Tracy Godfrey. She's down in Montclair, Glen Ridge area. And that market is just absolutely just ridiculous. It has not slowed down. She's been working with buyers and they're going well over $100,000 over ask on these houses. Nope. They're not
I
getting
forget
it.
where. I think this house was in Morris Plains, which
Yeah,
it's
I can
we're
see
in a
that.
we're in a hot area. This area of
I
New
know.
Jersey is a hot area.
I'm finding that Morris County, I think, is becoming more popular because I've lost a bidding war recently at a house all the way down in Chester. And I'm thinking, oh, who's going to live down there? Like, a lot of people apparently, because it's holy crap. I couldn't believe it. But yeah, I think that like up here in Bergen County where I am, we're still seeing the competitive, bidding wars and stuff. But I think because there's nothing for sale, it's so slim pickings up here. Everyone's venturing out, going down to Morris County or
Right.
even further south. So another interesting thing, this is totally off the cuff, it just popped in my head. Niche.com, that's the website I refer to a lot to my clients when they want to research towns and schools and things like that. They ranked all the counties from worst to best in New Jersey.
Okay.
And surprisingly, Somerset County came in first place. They were ranked the number one county to live in, to buy a house in New Jersey. Somerset County. Bergen came in second, which I was like, oh, okay. I thought Bergen, honestly, not to be snooty, but I thought that we would come. I thought we would be first. We're like, oh no, we're not. So it's just telling you, that people are now migrating to different parts of the state, and I get, and what they're paying. I just feel like all in New Jersey is just going to get so super expensive. So, we have a question here before I don't want to forget this one. Here we go. Sorry, Manny.
No.
All right, Alex Crudello. Hi, Alex. Thanks for joining us tonight. Would you consider a 15-year fix for your clients? He's a Keller Williams agent. Hello, Alex. So what do you say to that one, Manny? What about 15-year?
Well, first of all, thanks for the question, Alex. It always makes it fun. I would absolutely consider a 15-year fixed mortgage for a client as long as the payment was comfortable for them. I think that's the most important thing. However, I probably wouldn't recommend it. I would consider it, but I wouldn't recommend it. And the reason being is because I believe that, and what Jackie and I were going to get to is, I think come May 10th, we're going to see interest rates start to come down. And I believe in the next year or so, we will, if we're already not in the midst of a recession. Real estate, traditionally, if you go back and look at recessions, you'll see that real estate traditionally does well in recessions. So, and mortgage rates traditionally drop in recessions. So I would look at it and say, probably not to do the 30, do the 15. I would say take the most affordable payment because we're going to be refinancing in the near future. But I wouldn't forbid them from taking a 15-year mortgage. There's nothing negative about it. You obviously pay less interest over the life of the loan. But I don't think you're going to see the life of that loan, in my opinion.
Right. So would you also recommend to people, I know we always tried to do this, we never did it, where you make one extra payment a year,
Oh yeah.
of interest payment? Yeah. Okay.
Yep. I just hopped on a call. The client couldn't figure out, I closed their transaction, and I always keep in touch, check in after closing. And I just had a call with them last week and help them set up the biweekly payment because, they're younger generation. They like everything to be on the computer. And
Yep.
there was nothing for them to set up the biweekly payment, which is what you're referring to, the 13 payments in 12 months. They couldn't find it online. They couldn't find it anywhere. And lo and behold, they didn't have it anywhere. The servicing company didn't have it anywhere except to make the phone call. And well, the servicing company decided to solicit them, and I was on the phone. So it was kind of funny, actually. But I helped them get their biweekly payment set up. So
Okay,
yeah.
that's good. All right. So that's always a good thing to do. People are so nervous and they want to pay it off sooner. That's always an option. That's a good thing to do.
Yeah. So, I mean, just to say it out loud, for those that don't know, when you do a biweekly payment from the start of a mortgage, a 30-year mortgage, you're going to cut roughly 8 years off the mortgage. So you're turning your 30-year, into a 22-year
22.
mortgage by just paying that biweekly. A biweekly, for those that don't know, is a half a payment twice a month. Okay. So if you're adding it up, well, that's one whole payment. But the way that the calendar weeks work in the year, it equates out to 13 payments being made in a 12-month time frame, like
Yep.
you mentioned, Jackie.
Yes.
So that really goes right to your principal and takes you down roughly 8 years.
I mean, I like that rather than having a higher payment on the 15-year, right? So what's
It's
another,
flexibility
right?
and
What's another 17?
uncertainty. Yeah, people don't like uncertainty and high payments. So yeah. Hopefully
Exactly.
that answers your question, Alex.
Yes. All right, cool. Thank you, Alex, for chiming in. So, all right. So getting back to the different types of loans and things like that. So as I was saying, affordability, affordability is a big problem right now. And FHA is always an option. But because of the competitiveness in today's market, especially here in New Jersey, I'm finding it's difficult to get an FHA loan accepted. Are you finding that?
Yeah. Yeah.
I hate that.
So here's what I'll say. FHA is a great product, but nobody wants to see it, like you said. So we've got a very nice 3% down conventional mortgage. The debt to income ratio requirements are more strict than FHA, but
Right.
it does work. Fills a void if you need to have a low down payment like an FHA loan. But we all know even the low down payment loans, no seller wants that either, So
I know.
when you combine, the low down payment with an FHA loan, that's like a recipe for the sellers to run, right?
I know. It's really frustrating. But I just wish I can't wait to get back to the days where that's going to be more acceptable again. Because look, I'll be honest, even when I'm representing sellers and we see FHA come through, the first thing that they think we have, and look, I got to be honest with them, we got to think about the appraisal, right? Because they can't waive the appraisal, and in today's market, that's like a common thing.
Mm-hmm.
So we can't, and I hate that. I hate that part of it. But what are we going to do? Like, how can you can't do anything about that. And these poor people, they just want to get a damn house, unless, like you said, they can take advantage of your conventional, 3% down conventional program. So if they get their debt to income in a good place and they have good credit, all right, that'll work. But a lot of people, it's not the case. And it's just I'm on my soapbox.
Yeah, well, I mean, and you and me both, but I think, my job, is to make sure that I get the buyer in a conventional loan if they can do it. I've got down payment assistance programs that I can couple with a conventional loan. So whatever I need to do to make that client fit into a conventional loan, I'm going to do it.
Yep.
We've got the wherewithal, to do it.
Yep.
And if they don't fit in, then look, they're putting their best foot forward. And if the best foot forward is the FHA loan, well, then so be it.
Yeah.
It doesn't mean that, they shouldn't make the effort. It doesn't mean that they shouldn't go through the process to learn how to get to where they want to go for home ownership. And a lot of times when I qualify these people, FHA, let's say, I'll talk them through and coach them through how to get their credit score into the right zone, or where they need to be to get the proper price point to qualify for conventional. That's what I do, is I make a plan with the clients that work with me so they can get to where they want to go.
Right. And that's so important, because we just, the online ones, like Rocket Mortgage, they don't care. You're just a number. They're not going to take those necessary steps to help get you the right loan product and to help get you the house. They're just going to sell you whatever they got. And I just had that recently with a client. She was quoted a really low interest rate from Rocket Mortgage. Come to find out, it was an FHA loan. It would also come to find out her credit wasn't so stellar, but she had a ton of money to put down. She's putting a large down payment. And we got her onto another lender, and he said, "You just pay off your credit cards. Why aren't you doing that?" It was, oh my God, it was crazy. But again, you got to be careful with these online lenders. So we got more comments. This is awesome. Johnny, can you bring up the other questions here? Brian Wong, hello, welcome back. I love when you're here, Brian. Like, you're just like a faithful watcher. I love it. When can you lock in a rate? Do you need to find a property and make an offer to lock in the rate?
Okay, so I see that Brian had asked a question above that as well. So about a recast.
Let's do that one first. Sorry, Brian. Yes, we'll do that.
No problem. So I like both questions. The recast, I just spoke to a client about that today, an hour ago, 2 hours ago.
Okay.
We offer the recast. It's something that I use in my planning for my clients. This gentleman has a house he owns free and clear. He and his wife are going to sell it, and they want to qualify without having to sell their house. They have some money saved. They'd like to have more money to put down on the next house, but they don't until they sell. So the recast feature that you're asking about, Brian, is perfect for that situation, because they can take whatever down payment they have now, purchase the house, then go and sell, and then they take the proceeds from the sale and they do a one-time payment. Actually, you can do it multiple times over the life of the loan, but they take that lump sum, whichever they choose. And I like to talk it out with them, because that's a big moment. You don't always come into, the average person doesn't always come into $300,000, $400,000 of money, right? That's a huge amount of money to come into. It doesn't happen every day in a lump sum. So I talk it out with what that recast is going to look like based on certain numbers, post-closing with my client, to plan out what the best usage. Do they want to plan some with their financial planner? What do they want to do? But how do you find a lender? Well, you're looking at them. And the other question about locking a rate, should I answer that now?
Let's answer that one too. When's a good time?
Yeah. So I don't lock in ahead of finding a property. I know that there's a lot of companies that advertise these, mostly the online, lenders and such. I don't see the benefit in doing that right now. I believe in my heart and in my mind and in all the studies that I do, and all the information that I read, all the data about inflation and everything that I do is to be the best mortgage planner I can be. Rates are coming down. I have clients right now that are new construction, not closing until June. I have clients that are just under contract and the contract date happens to be in June, several clients. I'm not locking their rate right now, and I'm not locking it because May 10th, the inflation report, the CPI, is going to come out, and year over year, it's going to be lower than what it was. And then even the following months thereafter, based on where we were last year, the following, I'm going to say June, July, and August, without looking at the chart, but those numbers are all going to be favorable. And when inflation is going downwards year over year, interest rates are going downwards. So when can you lock in a rate? The way that I always do it is when you find the house. And I don't have any concern about that right now.
All right. Thank you for that. So just to reiterate this, May 10th, that's a key date. So pay attention.
Yeah. That's when the CPI is going to come out.
CPI comes out. They've been talking about this since the beginning of the year, that May 10th. And I just talked to Manny about this before we even came on, you know, just because I kept hearing that May 10th, and that's why, because they're predicting that that number is, the CPI is going to be lower, and that's going to bring everything back down. So that's when they originally said a couple of months ago, when they're talking about the May 10th date, that rates are going to be back in the fives. I don't know if that's what they're predicting. I don't know. Maybe.
Look, yeah, and you know, nobody knows, but
no, you're right.
That's kind of why I guess, you know, you want to talk to intelligent and studied people out there, and I'd like to think I'm one of those people. I believe that that's the case. I think by the data, it should be the case based on the year-over-year inflation numbers that are ahead of us.
Yep. All right, John, we got more comments here. I see Tracy joined us. There's my girl. Hey, Tracy, thanks for being here. I missed you. All right. Why is it that some lenders can waive the appraisals and some cannot? Can you coach me on this? Tracy, come on. You're not waiving appraisal. Like, what's the matter with you? You're not putting that in your offers? I'm kidding. So, Manny, can you touch on this? And it's funny she brought this up, because really quick story. When I first met Manny, so when my clients, we were in a bidding war and Manny was doing their loan. Do you remember I called you up? I think it was that Friday afternoon, and said, can you get an appraisal waiver certificate for them? Because they were freaking, this listing agent was like out of her mind, because she's like, well, you know, can you waive the appraisal? I said, but they're putting 40-something% down. Right? They were putting a large amount of money down. I said, appraisal is not going to matter because they're putting so much money down. And she's like, well, we're not comfortable. They're going to waive the appraisal. I'm like, well, let me see if we can get an appraisal waiver certificate. And that's when I called you, and you're like, yeah, let me do it. And then Saturday morning, you called me up and you're like, yeah, we got it. So anyway, let's touch on this for Miss Tracy, because Tracy needs to know.
So it's a great question. And here's what I'll say. A waiver does not come from an individual lender. It comes from Fannie Mae or Freddie Mac. Okay, so when we run the file through automated underwriting, which is basically the computer program of underwriting, it'll spit out a waiver or not based on the data that's able to be determined online. We'll get a waiver or we won't, based on the sales price of the house that we enter, i.e. from the contract, you know, or the offer. In our case, it was an offer, right? So I went ahead and had my loan assistant run it through automated underwriting right away, so we could get that information and know that we got the waiver. Because like Jackie said, the client had a significant down payment. I really believed that they were going to get a waiver just based on their credit, their debt to income ratio, and the fact that they were putting such a large down payment down. And the fact that I believed it didn't matter. The fact that we actually got the waiver and produced it so we could get the offer solidified was how the operation will work. Why can't you get a waiver? If you're putting less than typically 20% down, you might see a waiver at 10, but I don't think so any longer right now. But you're not getting a lot of waivers with lower down payments. So the lender or Fannie Mae or Freddie Mac isn't going to spit out a waiver unless you've got some equity, typically, like I said, right around that 20% threshold. And but the thing is, a buyer can still waive the right to an appraisal, even though we, the lender, will require one. So I want to make that distinction.
Yes.
Right?
Yep.
We can still, the buyer, you can still write up in your contract, Jackie, hey, buyer's waiving the right to the appraisal. I then will make a plan with them to say, well, if the house under appraises by 5% or 10%, what are we going to do? Are you going to come up with some money, Mr. Buyer? Am I going to help you with some more money and restructure the loan? And ultimately, there's a way to do that too in most cases. So we can kind of have our cake and eat it too, and say we're waiving the appraisal, but maybe we are not going to actually get the waiver as a lender, but I'll still have the wherewithal to help them restructure.
Mm-hmm. Okay. All right. That's cool. That is good. Now Tracy said my clients are 20 to 25%. Well, doesn't their credit play a role in that too?
Yeah, all the
Different credit.
factors: credit, income, debt to income
Right.
ratio,
Okay.
all of it will play a factor.
Yep.
And the loan type also, where the lender is delivering the loan.
Mhm.
You know, and how the lender delivers the loan. One of the things that I found after joining NJ Lenders, I've been in the industry since '01. Like I said earlier, I've been at a few mortgage companies, and literally it's 3, but which isn't a lot, which I'm happy about. But I know that from my experience in the business, the delivery of the loan and how the lender, like my company, like NJ Lenders, delivers the loan on the back end, whether they have certain overlays and requirements on their delivery of the loan post closing,
Mm-hmm.
that could affect what their ability to waive an appraisal is, or where they're selling or whatnot. I mean, Tracy, if you want to, I see they have great creds. I'm curious, you know, that maybe it's just that the price that they're offering is not accepted by Fannie Mae or Freddie Mac as good enough. You know, maybe if the price were lower, there'd be enough data online to get the waiver. That's the only, I mean, there are other variables, but that is one other variable that might have nothing to do with the client. It just might be that the value on paper, while it might be a market value that you guys set, right?
Mm-hmm.
That might be the issue. And I see.
Yep. Yeah, true that. She's
We'll take it.
All right, awesome. All right, we have a comment. Oh, my friend Peter is here from California. John, do you see that? There we go. Hi, Peter. Peter's been on before. Thanks for joining us tonight. We had the Cal FHA program that it ran out in less than 2 weeks. It was 500 million. So was that thought I heard about this. Can you like elaborate on that a little bit? What you crazy Californians are doing out there with all this? They giving money away? Is that what they're doing? Yeah. Let me know more about that, Peter. I'm curious about that.
Yeah, and I'm not familiar.
Yeah, I really want to know what's going on with that. Give me more details. All right. Brian is back again. Here we go, Brian. I was told by a realtor that a pre-approval with all the underwriting complete is just as good as making a cash offer. So yes, there are, and I've done this for clients before. They go to the pre-approval process is pretty much like they're going to the whole loan process, goes through underwriting with the exception of the appraisal and title, right? Right? Yes. So that's what they mean by that. So they're basically, their loan's approved. That's basically what it is. The loan is approved. You're handing in your offer and you're saying, here, my clients have their loan. It's ready. They're done. They're approved. We don't have to worry about it. They have their commitment. It's done. Right, Manny? I mean, you have that product as well.
Yeah, just one thing that I'll clarify. It's not the commitment that we would have. We would have
You're right.
we would have a conditional loan approval. The reason why we wouldn't have a commitment is we can only issue a commitment once the appraisal is in.
You're right.
But that's semantics, and the reason why it's as good as a cash offer is because the file's been underwritten by one of my human underwriters in Little Falls, New Jersey, right here. So the file's underwritten, credit, income, assets, everything is done with the exception, like you said, Jackie, the appraisal and title.
Yeah.
And so we call that our Home Buyer's Edge program, and we definitely offer that. It's something that I've found that does help give us a little bit of an edge, you know. So
it's a beautiful thing. Yep. I had clients 2 years ago take advantage of that. They were able to get one of those go through underwriting, and it was awesome, and it worked. it definitely worked. It gave us the advantage. If there was a cash offer, I don't know, may still have worked. I mean, we came with the highest number anyway, right?
Yeah.
So it definitely is, it's worth looking into. Okay. And let's see, Brian, again, does high DTI result in a higher rate? If not, is it just pure credit score that affects the interest rate? These are great questions.
Yeah. High DTI does not necessarily mean a higher rate. Sometimes a high DTI could mean you don't get a mortgage. But a high DTI does not necessarily mean you're going to get a higher rate. Credit score is a variable. Debt to income ratio is more a variable on what loan product you're going to fit into than an impact to your interest rate, although it can impact your interest rate in a small amount. My main criteria for interest rates would be your credit, your income, your down payment percentage. Those are the three top. I wouldn't say debt to income ratio is a huge impact on the actual rate that you're going to get, but that's a good question.
Yeah. Thank you, Brian. Brian always has the best questions. I love when he comes on. And Tracy, you do too. Just saying. Okay. Oh, Peter's back with, okay. Yes, they're putting down 20% for qualified buyers in exchange for a partial equity position that would recoup at a later time. This just made it harder for everyone. All right, and you've got the rest of the comment. Almost every home that went to market in the past couple of weeks went into escrow extremely fast. So they're putting 20% down in exchange for a partial equity position. Do you get that, Manny? I'm sorry, Peter. I'm a little slow in the uptake.
Putting 20% down. Oh, they were putting, okay, so he's saying that the FHA program was putting the 20% down is what it sounds like.
Okay. Is
for
that
the
right,
qualified buyers
Got
in
it.
exchange for a
Partial acquisition that we recouped at a later time. That
I see.
Okay, got
So
it.
it's like a forgiveness loan. It sounds like where they will. I would think that this 20% that they're giving would be forgiven if the buyer or the homeowner stays in the house for a certain period of time. Maybe Peter knows that part of it. Or if they sold the house too soon, then they'd have to repay that. But I believe it's like a subordinate mortgage position that they're giving is what I believe it is.
Okay.
So it makes, I think what the point of this is it makes the buyer look stronger because there's a 20% down payment, but really it's coming from FHA, not from the buyer.
Exactly. Okay. Almost like what we have in Jersey, like those first time home buyer programs, right? Down payment assistance. That's what it sounds like. Okay. But 20%. Oh my God. That's a lot.
Yeah, that is a lot. We've got a 10,000 and a 15,000 that we can do. I've never seen something like that. That's
California.
Must be sunny California.
Isn't that nice? What you hear? We'll just give you 20%. But just give it to, if we make sure you don't sell your house too soon, we want that money back. That's insane. But you see, it's things like that are helping people be able to achieve the dream, right? They want to get into a house. I mean, what we have here in New Jersey, it's okay. This down payment assistance. I don't think it's, I don't know. I don't think it's.
I think. I mean, and Peter might chime in again. I don't know if that's a little. That's risky. I would say you want the buyer to have skin in the game.
Yeah.
True. Otherwise you get into a situation where like a I don't even want to say, but you just get into a situation where somebody doesn't have an investment in the property. I like, skin in the game.
Yep.
I don't know how else to say it, but, and it doesn't sound like Peter's that elated about it. He said this just made it even harder for everyone. So Absolutely. I'm not sure that he's loving what this is doing
No, it's
to
right.
his
It makes
market.
it harder. Exactly. So for every home, because he said every home went on the market in the past couple of weeks, went into escrow extremely fast because people are taking advantage of that, and they're
I'm not saying it's bad.
right. But
I'm not pining for it, I guess is what I'm saying.
well, you know what I mean. From what I've read, that and Peter correct me on this. I mean, I know that some markets in California they're struggling right now. I mean, the prices have come down, so I can imagine the prices have come down a lot. You throw this now the state throws in $500 million to give 20% towards down payment. Oh my God. If that happened here in New Jersey, do you know? Oh my, I don't even want to think about. I'm getting like anxiety thinking about that. You know what that would have done? Oh, forget it now.
Well, it kind of makes me think of your question before to me earlier, which was, what do we think is going to make these sellers want to sell? What rate? What do we think is going to happen if rates went down to 5%?
Yeah. Oh, it's going to be hell again. It's going to be hell again.
Do you think people would list at 5?
Oh yeah, for sure. But it's going to be like that scenario. I think as soon as things hit the market, it's going to be gone. It's going to be gone. So from what I've read, they say it's going to take 10 years to get to the amount of inventory we need in this entire country to get everybody home. So, we can do all these things to motivate the sellers and build new houses, but it's still not enough. Right now, it's not. But so wait, what is this? The buyer. Sorry, I got distracted, Tracy. The buyer does have skin in the game. Are you in Jersey? Are you talking to Manny? Yeah, Manny's in Jersey.
Yeah, Tracy, I was talking about Peter's comment on the FHA 20%.
In California.
The FHA is in California.
Yeah.
So the buyer does have skin in the game. I'm right on the same page with you.
All right, right here. So Peter says it makes sense here in OC. That's right. He's in Orange County. In OC, where the median is 1.08 million. So it's good for qualified buyers who might not have the cash to compete with a step-up buyer. Okay, now that makes sense.
Very good.
Thank you, Peter. Thank you for elaborating. Now that makes sense because I'm thinking, oh my God, 20%. Yeah. Okay. Yeah, I forgot you're in the OC and it's very expensive in the OC. So, anyway, no, this is interesting stuff. This is good, really good discussion tonight, guys. I appreciate you all being here. So, but getting back to increasing the inventory, I don't know. Is the 5% going to do it? I think it will, but I just think it's a temporary thing for now. I don't know. Like I said, whatever had 10 years before we're going to have enough inventory to meet every person in this country, like they have a place to live. And then we won't get started on those stupid investors. Right. Well, you and I were talking about that before, about these, the big corporate real estate investors who are scapping up the homes too.
Buying up all of our single family homes as investment properties.
Yep.
The scary statistic that I heard, and I mentioned it to you, was, I don't know if scary, that might be a little dramatic, but it's a statistic that I didn't particularly like because most of the people that I help are families. And so when you see these big money investors going in the fourth quarter of 2022 purchased 26% of all the homes in 2022, investment homes, I should say, and they purchased them as investment properties as opposed to, the individuals buying these homes. It's a large percentage.
I know.
And the trend that I heard in the same, statistics that I was reading was something like 40% or 44%. I forget the numbers. I don't have them in front of me, but so don't crucify me if I'm a little off. But by the end of the decade, so in 7 years from now, that number is expected to be up to somewhere in the 44% range. I made a post on LinkedIn about it and my Facebook business page. So whatever the numbers were, I had them in front of me at the time.
I gotta check that out. Yeah.
I just, I think when you see that type of trend and hear that type of trend for the future, you worry about how's the individual first-time home buyer going to compete, or how is any individual going to compete? And I think the media gives a very poor view on home buying right now.
Yep.
And I think that's why we're doing this, is to get a better message out,
Yes.
to people, and at least have a better discussion,
Yeah.
and see where it goes.
Got to talk to the experts. Got to talk to your local experts, because we're the ones who are in it. And Peter just commented, 4 in 10 homes will be institutional owners.
There you go.
Thanks, Peter.
Well, at least Peter knows, and the rest of everybody knows I'm not pulling this out of my.
No, nobody's saying that. I know, but it's just like, but when you see like 4 in 10 home, oh my God. And then Tracy, what are you saying? So what Caribbean island should we land on? I don't know. You tell me. Where do you want to go, Trace? I'll meet you there. It'll be great.
See you there.
So, all right. So listen, we're at about an hour. My God, this is like this flew. Manny, I appreciate you so much for being here.
Ditto. This was so much fun. I appreciate it.
No, I would love to have you back on.
Anytime.
I love having my lenders on, because I love getting your perspectives. And, it's like, again, we're here to send the message, right? We're here to educate everybody on like what's really going on, and like stop worrying about what the media is doing. So, anyway, okay. Sorry. Saw a comment there. Anyway. All right. So Manny, I just saw Peter's comment. Sorry.
Peter's been involved today.
Yes.
Actually, everybody was great. It's so nice to get the responses and comments and whatnot. But go ahead. I'm sorry.
No, but Manny, where can we all find you? Can we get your contact information? Actually, what I'll do is I'll put Manny's contact information down below. Manny, again, he's with NJ Lenders. What part of New Jersey do you? I know you pretty much serve the entire state, right? But what's your primary like market area?
So my office is in Morristown, so I mean, draw a big circle around Morristown. That's kind of my areas: Morris, Bergen, Warren, Somerset, Hunterdon.
All right.
Those are where my relationships are, and honestly, that's what my business is. It's all relationship driven. I'm not an online lender. It's a relationship with you, Jackie, with the clients that we share, with the real estate attorneys, title, everybody. It's a relationship. And I think in this market, that's what wins. And I'll just pat you on the back, how you come to it when you present an offer. Your name, your reputation means something. Mm-hmm. And so I think the relationships that we've got are what makes us, valuable assets, in addition to our brains too,
Absolutely. Absolutely. Yeah. But it goes, and I have to add this too. It really is important when you're walking into an offer, and Tracy and Peter, all you agents out there can probably attest to this too. When you walk into an offer and you're presenting it and you have a team behind you, meaning that you are partners with the lender, most important, the attorney, you have that relationship, right? We all have relationships. We trust each other. We know we're working together to get our client to the closing table. So even though like I literally just met Manny, I got him on the phone and said, this is what I need to get done. And, we had a great conversation, and I was able to walk up to the listing agent and say, look, this is who I'm working with. He assured me we're going to get the appraisal waiver certificate. This, totally qualified, blah, blah, blah. Then I think you talked to them too. Didn't you get on the phone with that listing agent?
Yeah, I'm certain I did. Yeah.
Yeah, I'm pretty sure you did. So this is what's important, especially in today's market. You all need, there's a team. You got to have a team behind you when you're walking in and handing that offer. Like buyers saying,
I think that's what makes an offer get accepted in a lot of situations.
Because it makes it easier on the seller too. Because if the listing agent goes back and says, you know what, these people are solid. They have a good, the good lender. They know the attorney. They have relationships. They feel there's a certain level of comfort they have to feel knowing that transaction is going to be successful. So I look forward to working the next deal with you, Manny, because you were just an absolute pleasure to work with. And I'm so happy to have you on. And again, I will put Manny's information down below. Please give him a call if you have any questions. He's phenomenal to work with. And So, and if you want to get in touch with me, if you're watching this after the live, if you're watching this on the replay, go to my website, JackieBakerSellsNJ.com. There's a contact form down below. If you're interested in looking to buy in New Jersey, looking to sell, put all that information there. It will get to me. I will get back to you within 24 hours. So that's what we have. I can't thank you enough, Manny. This is wonderful. Thank you, everybody, for being here tonight. Great conversation as always. And I will see everybody next week.
Awesome.
All
Thank
right.
you so much.
All right. Thank you, Manny. All right. Everybody have a great week. See you next time.
Have a great week. Bye-bye.
Bye. And